Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Today we're checking in with Simone Haslinger from East Coast Capital Management. Simone, welcome.
Hi, Chris. Great to be here.
We speak regularly. We talk about what's going on in the trend following world and what commodities, currencies, etc. are moving. It's been a pretty volatile 3 months, to say the least. Tell me how the fund's gone and what's happening in the world.
So, look, we weren't immune to the volatility in March, but we outperformed traditional assets. We were up quite reasonably for March, up about 7%. Sorry, for the March quarter, and that's compared to traditional assets that were actually down for the first quarter of the year. A great benefit to us in the quarter was that we had a very strong January and February, and so that gave us an overall very solid result for the 3 months. So regarding energy markets, we're systematic in our approach, and we follow price trends across 90 different global futures markets. We don't try to predict what's happening or what will happen. We respond to what is actually happening at a point in time. And our systems actually identified that energy markets were starting to move as the US was beginning its posturing earlier in the quarter. And then, of course, energy markets took off in March as the conflict escalated and the fears around the implications of closing the Strait of Hormuz intensified. Ultimately, whilst we saw earlier in the quarter that equity markets, particularly in North Asia, were very strong, gold was up, energy was just starting to move, and then obviously towards the end of the quarter, we really had a reversal of a lot of those dynamics. Volatility can create some short-term indigestion, but it also creates longer-term opportunity as it can lead to sustained price movements that ultimately drive strong trends. So a really complex quarter. But, looking ahead, we see real opportunity created by those movements that we saw over the last several weeks.
So it is complex, but do the trend following signals, the fact you're systematic, see through that, or do they get whipsawed around by it, or a bit of both?
Yeah, it really depends on the nature of the move. So when we have extreme whipsawing in markets, absolutely, that's not a good friend for trend following systems. But what we find is that when you have these sorts of dramatic moves, they can actually be a precursor for more sustained market regime change, what we like to call market regime change. And so when you have those sorts of moves, it's about creating the precursors for longer term sustained trends, sustained movements in pricing. And that's when trend following really excels. So it can be a bit of both, absolutely.
So you're talking about regime change. You're not talking about geopolitical regime change, are you? Or we're talking about market regime change?
Market regime change, but in this case, political regime change, I guess, is playing into that as well. Look, I guess the point is that for most of the past decade, markets have operated in a fairly benign market regime. So that's low inflation, low rates, central banks acting as a backstop, and equity markets have broadly been performing reasonably well or grinding higher, or in some cases really moving quite strongly. And traditional portfolios perform quite well in that kind of market environment. What we're seeing now is it's really got the hallmarks of more significant market regime shifts. We've got geopolitical fragmentation, we've got persistent inflationary pressure, supply chains are being rewired, and energy markets obviously being very significantly repriced. And that kind of regime will lead to relationships between asset classes shifting. So stocks and bonds moving in opposite directions, which is the sort of underlying presumption behind a 60 portfolio, for instance, that can break down when you see these sorts of market regime shifts. And that's exactly the environment when we would suggest investors really ought to be thinking about having something else in their portfolio that isn't correlated and gives you true diversification. And ideally, an investment that's designed to find opportunity where prices are moving with conviction, i.e. trend following.
Simone, your March quarter, you're up 7%, almost 7%, and 11.3% for the past 12 months. Where did those returns come from?
The quarter was really a story of two halves. January and February, the Iran conflict flaring up saw really strong momentum in global equity markets, not so much in the more familiar equity markets for Australian investors. So the Australian market and the US market were a little more anemic, but North Asian markets in particular were very, very strong earlier in the year. And as you say, precious metals were also performing. Energy was starting to move, but it was less of the story. And then, of course, in March, we had the energy shock, and that was very rapid, very sustained, and so obviously created some shocks for a very large number of funds across the world through the course of March. But we were able to adapt to the shift in markets, and we've captured gains across what is really a complicated quarter, as we've talked about, and importantly, managed to finish the quarter in the positive when traditional portfolios were losing ground.
Simone, if we're entering a different kind of market, as you say, you term it regime change, how's that going to either affect what you do, or how's what you're going to do going to manage that kind of regime environment?
Yeah, so unlike other strategies, trend following doesn't actually need stability. What we need is movement, and ideally fairly sustained movement in pricing. And regime change means assets reprice and start to reflect that new reality. And typically that pricing doesn't happen super rapidly. It happens over months, years, as the full implications of those structural shifts start to flow through different asset markets. And the beauty of trend following is that we don't have any fixed ideas about how different asset classes should move with one another. The system is designed to identify those sustained moves in various different asset classes early on as those moves emerge, and then stay with them as they develop. And we've seen that play out in previous years. In 2022, for instance, trend following did very, very well relative to other asset markets because the world was repricing at that stage to higher inflation and a higher rate environment. And we see some parallels here where the move in oil in March may well be the start of something that is a much longer sequence for trend opportunities. And trend following ultimately is positioned to capture those sorts of opportunities as they emerge.
Simone, we talked about the market, and obviously energy has dominated the market in the same way as precious metals dominated the previous market. Were returns primarily focused on energy, or was it more across the board?
So what was interesting in the last quarter is, of the top movers across the quarter, and we published this in our Australia Trend Report, the first 8 were energy-related markets, and the standout was actually gas, oil, or diesel, which was up 173% for the quarter, which is obviously breathtaking. But as you move further down the list of top movers, you're starting to see some agricultural commodities like soybean oil, rapeseed, canola, wheat, palm oil starting to move. And so that, to us, is quite interesting, that it could be an indicator of that structural regime shift starting to flow through into other commodities, and that persistent inflation starting to be reflected into other asset classes. So that's an area to watch, and something that we think is very interesting.
And is the supply side on some of those agricultural commodities going to have a big effect as well, as a sort of follow-on?
Absolutely. I think that's a big part of what we're seeing now as we think about all the potential second-order effects of the initial move to take a stance in Iran by the US and Israel. But as you start to disrupt supply chains internationally and increase, probably result in increase to energy prices for a sustained period of time when you're destroying infrastructure and reallocating how energy flows around the world. What that has to start to have an effect on is, as we're already seeing in the news flow around the cost of fertilizer, for instance, it has to have flow-on effects into other commodities around the world over time.
Simone, I'll look forward to catching up with you again in 3 months' time, maybe before, you never know. The world may have tipped by then.
Indeed.
Thank you for your time this afternoon. We'll look forward to speaking again soon. Best of luck with East Coast Capital Management.
Thanks, Chris. Appreciate it.